Hey scholars, welcome back. And in this video, we will be practicing some questions which appeared in your mock exam. So let's begin our first question and try to understand the tricks and tips from each question, because similar sort of question or any different kind of version may appear in your real exam. So let's begin with our first question. On 1st April 2018, the company had 20 units in inventory costing £21 each. During the month, the following transactions occurred. So look at this data. They bought 28 units at the rate of 25 each, but on next date, 11th of April, they sell. So we will just take this type of question appears. Then we will take the question statement first. They're asking you what is the value of closing inventory and the cost of goods sold for the month of April to 2018 using FIFO costing method. So here we have to make this arrangement first. Initially, we have 20 units at the rate of £21 each, and then we bought 28 units at the rate of £25 each, and then we sell it. Just ignore this. I'm just making a sequence of purchase. And then we bought 60 units at the rate of 24 each, and then I bought 70 units at the rate of 27 each. And then the last transaction was issuance of stock from store to selling department. So basically they are giving you sale value. Some students get trapped in this pricing because whenever you are calculating the cost of sales, you should not take the sales value. Okay, just point to remember. So this is a sequence of purchase. Let's make its breakup and how we used these things in our calculation of cost of goods sold. So in the first issuance, issue number 1, we issued how many units? We have to think. We issued 32 units. So 32 units, because we are using FIFO, first in, first out method, 20 units will be taken from the first slot. So again, 20 units will be taken at the rate of 21 each. So that is going to give you some value. So you can calculate that. When from the next slot, 28 units, we are going to issue 12 more units, because in first issuance, we need to issue 32 units. And in this way, 12 units are going to be taken from this slot at the rate of 25 each. If you just calculate the value of this, that's the first issuance. Okay, fine. The next, okay, after we issue first one, we are left with 16 units from this slot. So 16 units are left from this slot that will be consumed in the next issuance. Okay, fine. In the next issuance, we are supposed to issue 64 units, issue number 2. Issuance number 2 is 64 units, but how we will be consuming? First of all, we will consume these 60 units completely. So 16 units at the rate of 25 each. And from this second last slot, 60 units, we will be consuming 48 units. And 48 units times 24 each, then these two blocks, which I have highlighted, these two blocks, if we add all the cost of these blocks, there's going to be cost of goods sold. I'm going to calculate a little bit later. So cost of goods sold can be calculated from these two blocks, mean 20 times 21, it gives you some value. And then 12 times 25, it gives you some value. So if you add all of these values, then this will be your cost of sales. Okay, fine. We are left with 12 units from this slot because we issued 48. So if you just scroll a little bit to calculate further values, so we are going to calculate ending inventory. Ending inventory, how to calculate that? So look at this value. 12 units from this slot and completely 70 units are not consumed yet. So 12 times 24, we are going to calculate the ending inventory, 12 times 24. Because these are the units left with us, and 70 units left with us at the rate of 27 each. So if you just calculate these values, this is going to be ending inventory. So let's use our calculator now. So first thing is the ending inventory. Let's calculate. 24 times 12 units. It gives you 288. So let me just write here 288 plus 70 times 27. 70 times 27. It gives me a value of 1890. So just 1890 plus 288, it gives you the ending inventory value plus 288. That's going to be equal to 2178 pounds. So this answer is prevailing in option A and D, but we are not yet confirmed what is the cost of goods sold. So let's calculate the cost of goods sold for this. So 20 times 21, I'm using my calculator. 21 times 20 is going to give me 420 for this. And then 12 times 25 is 300. 16 times 25, it's giving me 400. And 48 times 24, it's going to give me 1152. So if you add all these values, 1152 plus 400 plus 300 plus 420, so it is giving me 2272. That is going to be my cost of goods sold. So 2272 and ending inventory. So option D is the correct answer for this type of question. So you can see in this type of question, a lot of calculations are involved, but the trick is you should never use the selling price when you are calculating the issuance, because we are using FIFO costing and we have to take only cost of these items and according to first in, first out method. So the obvious answer is D. That's the correct answer. Let's move to the next question. And this is another type of question. On 1st April 2018, trade receivable were 156,500. Some received from the customer or receivable were 144,300 pounds. At 30th of April 2018, trade receivable were this. That's basically closing inventory. Sorry, closing balance of trade receivable. This is the opening balance of receivable. This is closing balance of receivable. And you know what is the meaning of closing and opening balance? The normal balance of receivable is a debit balance. So we will brought down debit balance by making T accounts. Cost of sales is given to you. They are asking you what is the cost value of gross profit. So first of all, we need to have value of sales, and I'm going to make account receivable T account. And you know that the opening balance of receivable is always brought down on the debit side because this is the asset account. So 156,500 is the balance brought down. And the balance carried down, the closing balance is also given to you, 170,700. That's the closing balance carried down. During the year, we received money from customers. That's the cash received, and it is posted on the credit side of account receivable. How much cash received from the customer? Sum received from them was 144,300. So you know the meaning of T account and how to make that. So this is opening balance, this is closing balance, this is cash received from them. So only one value is missing. That's the credit sales. Okay, let's calculate the total of this and find the missing value first. If you total them, the greater side will be debit side because this is an asset account, 156,500. Sorry. The greater side is this because these are two values and one value is missing here. So greater side would be this. I'm just totaling both of the values and I'm getting the answer. It is equal to 315,000. On both sides we should post. And then minus 156,500 from 315,000, you will find the missing value. And the missing value of sale is 158,500. If you know what is the value of sale, now you got it. 158,500, and you have been given the cost of sales in the question statement 81,000. If you deduct cost of sales from sales, you will get the gross profit. That is your question. So the gross profit is 77,500. So 77,500, answer is D. Again, our answer is D. So here you are understanding how to solve exam type of question. So let's move to the next question now. Now we have our question number 3. Here we have question number 3. Which of the following represents the statement of financial position equation? Obviously, this is a very easy question. Assets must be equal to liabilities plus owner's equity. So the first statement, assets are equal to liabilities and owner's equity, that is 100% correct. Remaining all equation are not correct. So our answer is A. So just move to question 4. And before we solve this type of question, please understand, in this type of question where you have to select multiple answers, like A have option 1 and 2 only, 1, 3 and 2 only, in this type of question, the trick is you have to use elimination method. And let me just use that elimination method. Elimination method says, if you find one mistake in the options given, the mistaken one would be eliminated from all other options. Let's try this. Which of the following are differences between sole trader and a limited liability company? They are asking you the differences. Point to be noted, they're not asking you the similarities, okay? Differences. A sole trader financial statements are private, okay? And the company financial statements are sent to shareholders. Yeah, that is the difference. Correct. So option 1 is correct. Now see, option 1 is not here in D. So it means it is altogether eliminated. Because option 1 is correct and this option 1 is not here in option D. So this is also eliminated. But option 1 is prevailing in A, B, and C. So we have to check. So we eliminated one option. We are left with 75% options. Only company have capital invested into business. I don't think so this is correct, because whenever there is sole trader, they also invest capital in the business. So this statement is conceptually wrong, because both the companies invest. Sorry, both the businesses invest in the business. Not only the company has the capital. So this option is technically wrong. And let's see, option 2 is here. So this is eliminated. This is eliminated. And we are left with only one option. So let's confirm it from given option. All sole trader is fully and personally liable for any losses. That is basically unlimited liability the business might make. Okay, that's unlimited liability, meaning the company shareholders are not personally liable for any losses. That is limited liability. Obviously, this is correct option, and it means we found out option 1 and 3 is 100% correct. So option is C. I told you already, this is elimination method. We can use elimination method instead of conceptually focusing on every single question. This will save your time in the exam paper. Question number 5. Again, this could be applied in the elimination method, or let's see what happens here. Question number 5. Mary owns and runs a restaurant. The following describes some of the items on her statement of financial position. Which ones are liabilities? So they are asking you which one are liabilities. Some are given as assets, some are given as liability. So we have to see which one are liabilities only. Okay. Restaurant tables and chairs, that's asset. Wages owed to waiter, that is liability. Bank account containing 300 assets. Table bill paid, authorities, due, sorry, this is liability. Restaurant premises at cost, asset. Loan, liability. Food supplies is an asset. About amount due to the baker is a liability. It means if you see all even numbers are liability. So that's the option given to us. This is correct one. Okay, now let's move to question number 6. It says business acquires a machine costing 30,000. That's the cost of machine. And expected useful life of this machine is 5 years. And residual value is 2,000, sorry. The business uses straight line depreciation. The machine was sold for 8,000 pounds at the start of fourth year. Point to be noted. At the start of fourth year. It means we need to consider only 3 years depreciation, not 4 years depreciation. You need to calculate what is the loss on this machine at the disposal time. So for calculation of loss, we need to have carrying value of the machine at the end of 3 years at the start of fourth year. So the cost of machine was 30,000 minus residual value 2000 according to the formula of straight line depreciation, and the estimated useful life was 5 years. 30,000 minus 2000, 28,000 divided by 5, it gives you 5,600 pounds. Per year depreciation, 5,600 pounds. You need to calculate 3 years depreciation, just multiply with 3 years. You will have the accumulated depreciation 16,800. Okay. Now it's very easy for you to calculate what is the book value for this. The book value is cost of an asset minus accumulated depreciation. That gives you book value. And it was 13,200. The asset carries the value in the books 13,200, but it was sold out at 8,000. So it means the book value is more than the carrying fair market value. That's the loss on disposal 5,200. So we will see 5,200 is the option. That's loss on disposal. Very easy. So in this type of question, just calculate depreciation for 1 year, multiply with the number of years you want, and then deduct this accumulated depreciation from the cost of asset. This gives you net book value of the asset. And then this is the selling price of the asset. If the selling price is higher than the net book value, it is a gain. But in this situation, this is not a gain, this is a loss. So this is loss on disposal of asset. That's it. Question number 6 is done. Let's move to question 7. Here we go. We have this one. And this is a little bit logical question. In the context of accounting concepts, which of the following most closely defines prudence? And by the way, prudence is basically whenever you are expecting any future loss or future expense, you can recognize them. But if you expect any gain or benefits in future, you can't recognize in before time unless they occur. So here we say using caution. Option 1 says using caution when making estimates in condition of the uncertainty. The point is they are talking about the uncertainty. You are making careful precautions. Let's suppose bad debts, and you are estimating by careful estimation how much would be my uncollectible from receivables. That's the application of prudence. And this is the same thing which is they are saying we are making caution about the future uncertain condition because bad debts are uncertain. Okay, fine. That is one of the probable answer, but I'm not confirming it now. Let's see what other options say. Accounting for the transaction on their original cost. No, that is historical cost principle. This option is incorrect. Including all expenses for the year, irrespective of the date on which they were paid. No, we consider prepayments separately and payments of this expense separately. That is also wrong option. Okay. Option D says understating the assets and revenues and overstating the liabilities and expenses. Here, this is a little bit technical and logical to understand. When you know that asset is going to be understated and you know that, that is not an uncertainty then. If you know that the asset is evaluated or reported in the balance sheet in the value which is not according to the fair market value, and you are reporting the asset at historical cost, and current market value is more than the historical cost, It means the asset is understated, and you know what is the historical cost and what is fair market value. Both of the values are known to you. Nothing is uncertain here. And that is not a prudence. Whenever you are certain about something, that is not a prudence principle. So you should not be confused on this option that this is really application of prudence. That's not the case, because prudence is talking about the uncertainty. And when you are certain about something, in option D, you are certain about the fair market value and historical cost. That is why you are saying we reported the asset on understated value. Why understated value? Because you know current market value and historical cost. You know that. There is no uncertainty. That is not the good option. So only option left with us is A is correct, because we are making precaution or fair estimates about the future uncertain events. That's basically application of prudence principle. I spent more time on question number 7 because this was a little logical and few students were having queries about this. So I made this point more clear. When you are certain about something, that's not uncertainty. That should not be prudence principle. In the prudence principle, you are making caution for any uncertain in future events. Question 8. Again, elimination method will be applied. In respect of four statements above, these are four statements. Which of the following combinations is true? Okay. A debit to an asset will increase the asset value. Yes, it is true. I agree with this because the increase in the asset is debited, decrease in the asset is credited. A credit to an expense will increase expense. That's wrong. This is totally wrong. Now, elimination method, try to use this. Option 2 is wrong. Option 2 is here. This option is eliminated. Option 2 is here. This option is eliminated. Option 2 is not in C and D. Maybe one of the possible answer is C or D. Let's see. It means we eliminated 50% options now. A debit to liability will increase the liability. No, no. Whenever liability increases, it is credited. And whenever liability decreases, it is debited. So this option is also wrong. So option 3 is also wrong. And option 3 is in C. It means this is also eliminated. Only option left with us is D. So D is the correct answer. So please stay connected with the videos. I'm going to record another video with remaining questions. Okay? Take care.